Okay, good morning, everyone. Today is the fourth day in February 2023, and today we'll be having a discussion with respect to demonstrating our understanding of how to present an IFRS general purpose financial statement and in line with the requirement of IAS 1. Now, before now, we've had sessions, both physical and virtual sessions, where we've discussed extensively about the principles regarding IAS 1 and also the practices. Today, we'll be making use of one of ICAN past questions, which was specifically question 1, a compulsory question, 30-mark question, in the November 2021 diets of the Institute of Chartered Accountants of Nigeria under financial reporting, where we will make use of that question to demonstrate further our understanding, which will represent the second practice question we are able to make use of in our discussion so far regarding presentation of financial statements. Now, in that light, I'm going to switch to the board where we have the ICAN question. And I want someone to volunteer by raising up a hand so that I can grant you an access to do so. Okay. Who's volunteering? Am I waiting a hand? I've not seen any hand yet. Okay, who's going to raise up an hand? Yeah, I can't. I believe you guys can hear me. Okay. Is the deputy governor there? Okay. August 19, you can proceed.
Hello.
Hello, sir. You can proceed.
Good morning, sir. This is Governor speaking, sir.
Okay, Governor.
Yes, sir.
Okay, you can read the question then. Thank you.
Okay, sir. It's not showing very well on the screen. Okay.
Yeah, I'm switching it to it now. Over to you.
Okay. Financial reporting. Question 1. The trial balance for United Nigeria PLC as at December 31st, 2020 is given below. Giving debit and credit. And I won't read the figure, I will just read the other aspect of it.
No, I want you to read, the other aspect. You can read those description. You can leave the figure, but read the description.
Okay. Purchases / revenue. Inventory, 1st of January 2020. Property, plant, and equipment at cost, 1st 1/1/2020. Property, plant, and equipment accumulated depreciation, 1/1/2020. Interest on 10% loan note as at 38/6/2020. Discount, distribution expenses, retail earnings, administrative expenses, bank balance, bad debt written off, 12% preference shares, 10% loan loads, ordinary share capital of 50 kobo each, share premium. Let's draw it down small. Okay. Share premium, returns, allowance for trade receivable and payables, additional information, One, inventories at the end of the year were 120 million. Included in the closing inventories was damaged item with a cost of 30 million, which has a net realizable value of 18 million. Number two, additional ordinary shares of 50 million were issued and fully paid for at 80 kobo per share. This is yet to be recorded in the trial balance. Number three, interest on 10% loan note is outstanding, and dividend on 12% preference shares were paid on December 31st, 2020. Existing ordinary shareholders were paid dividend of 5 kobo per share on December 31st, 2020. These are yet to be recorded in the trial balance. Allowance for trade receivable are to be increased to 50% per annum. Depreciation is charged on plant and equipment, PPE, at the rate of 15% on reducing balance basis. 5 million naira administrative expenses were outstanding, and 25 million naira company income tax is estimated for the year. Depreciation is charged to administrative expenses. You are required to prepare the following. A1, Statement of Comprehensive Income of United Nigeria PLC for the year ended 31st December 2020. 2, Statement of Changes in Equipment for the year ended 31st December 2020. And 3, Statement of Financial Position as at December 31st, 2020.
Thank you very much. Thank you very much. We'll stop there, okay? The other aspects relates to a topic you've not covered, okay? We just want to address now the presentation of financial statements. Okay, now the second question you read is statement of changes in equity for the year ended December 31st, 2020. Okay, now if you add all of the marks together, that gives about 25 marks, which is like 1/4 of the entire mark in the examination. And this is a compulsory question. Therefore, what do we do at this point? Now, I've replicated this question in my exam model, which I've shared with you, the template. And I believe you can see the template now. Can you see my template?
Yes, sir.
Okay, thank you. Now, going by that, what then do we need to do? Now, remember, under conceptual framework and also under IAS 1, we have more or less discussed extensively on the presentation. What is the manner of presentation in the financial statements? And therefore, we want to demonstrate that understanding once again today. And to do so, I have these templates before me. Okay, and the question has been replicated. Okay. Now, let us start from this trial balance. Let us look at this trial balance and try to make 1 or 2 explanations about it. The item contained there. Now, technically, in an ideal trial balance, every line item is separated from one another, which means purchases should be separated from revenue. But again, the examiner wanted to test your understanding to know which one is on the debit side and which one is on the credit side. Now, if you go back to our convention, okay, if you go back to our convention, you all remember that we discussed something, which probably let me put it somewhere here, that we have elements of financial statements. And there are 5 elements of financial statements: assets, liabilities, equity, income, and expense. Okay, and in that we said by convention, you expect assets to be on the debit side from your basic accounting principle. You expect liability to be on the credit side. You expect equity to be on the credit side. You expect income to be on the credit side. And you expect expenses to be on the debit side. Okay, and this speaks volume to what we wanted to do, which means purchases is an expense. Therefore, 300 is purchases, while revenue is an income, 680 is a revenue. That's number one. Number two, if you remember in class, I discussed with you that you can either more or less adopt perpetual inventory system, inventory management system, or you adopt periodic inventory management system. And one of the differences between them is with respect to whether you recognize purchases in your general ledger or you recognize inventory. Now, the approach here is periodic because purchases was recognized. Okay? Whereas if you use perpetual, inventory will be recognized. And once you sell the goods and recognize revenue, you release from your inventory to cost of sales. That's why you find cost of sales in the trial balance. But in this trial balance, you didn't find cost of sales like the first one we did then, but you found purchases now. Now, when you find purchases now, what goes with it is the opening inventory, and which is what you have here. If you remember, the year ended at 4 December, but the inventory given to us is of January. Is to corroborate that we have used periodic, where you have purchases and opening inventory. But if you use perpetual, what you have is cost of sales and closing inventory in the trial balance. But here, you find out that closing inventory is always by way of additional information, because based on periodic system, you then need to do inventory count and to more or less take note of it as an adjustment you are going to make to your trial balance in the process of preparing financial statements, which is what we're going to do now. And that's why you can see inventory figure here at 120, closing inventory at the end of the year. Okay, that explains that. Another thing is that these two items here relates to PPE, property, plant, and equipment. But the first item here relates to the cost of the PPE, which is the initial cost as at when the PPE was purchased, and which is the same cost you are carrying up to date. And you never revalue them, because the policy of this company, from what we are seeing here, is that they carry PPE at cost. But there's depreciation that will have been charged over the years, at least up to last year, and which is what we brought forward as accumulated depreciation this year, this 390. Now, what this presupposes is that this is also a component of assets, but it's on the credit side, whereas we said asset is on the debit side. Why? Because this component of asset is to force the assets to a reduction. Okay, remember in class I told you about what we call asset reserve. Okay, these are allowance account or any form of account that is a charge on an asset to reduce the cost or value of such an asset to its carrying amount. One of those examples is what you are seeing here. Accumulated depreciation is not a liability, though it's on the credit, but it is a charge against the cost of the asset to write it down to the book value. Okay, which means all things being equal, this will be used to reduce 950 to its book value as at the beginning of the year. Okay, but this has not yet taken cognizance of depreciation for the year, which we provided additional information to. And what's the additional information here? We're told that depreciation is charged to administrative expenses, and we're also told something here. Okay, that depreciation is charged on PPE at the rate of 15% on reducing balance basis. We'll come back to that. Okay, interest on loan is an expense, but there is a comma here. The comma there is that we need to be very diligent. Interest on loan notes as at 30th June 2020. But remember, the year ends 31st December 2020. The question then we need to ask is that, has the loan been paid as at June 2020? But when we check our trial balance, we still have the loan note outstanding till the end of the year. Which then means that we have only accrued for interest and probably paid for the interest for the first 6 months, which means we have a balance of the remaining 6 months between 1st of July 2020 to 31st of December 2020 to accrue for. Remember, our basis of accounting as a going concern is accrual basis. Okay, also we have an item here they call discounts. And if you go by the account question, they only wrote discounts, and there are 2 items there. But remember that debits should be an expense, and credits should be an income. Therefore, it means the discounts you pay out or you give out to customers is a discount allowed, which is on the debit. And the discount you receive from your vendors or suppliers is on the credit. Just take note of that, okay? Distribution expense was given to us. Retained earnings as at the beginning of the year was in credits, which means we have been making profit over years, okay? And that is a portion that is here to be distributed by way of dividend. Okay, administrative expenses is given to us. Bank balance is given to us. Bad debt written off, which is a charge, is an expense. That is, those receivables that is already bad, which means you cannot collect again. 12% preference shares we are given. And we have to be careful about this. I like this because I'm going to discuss extensively about it. I'll give you a clue, which I've mentioned before in class. But when we get to financial instruments, under IAS 32, we'll discuss extensively on preference shares as hybrid instruments. Now, what do we mean by that? It means preference share capital can either be recognized as equity or be recognized as liability, which means it can take any of these 2 forms, equity or liability. Now, at what point is it equity? It is equity where settlement is not required, which means preference shares such as irredeemable preference shares, okay, and they are not cumulative in nature, are usually equity, while redeemable preference shares are usually liability. But for now, we'll see whether the additional information that will tell us what classification can we give to this preference share, either as equity or as a liability. But we'll come back to that later. Loan notes is a liability, which is what we have to repay at a later date. Our ordinary share capital, the nominal price is 50 kobo per share. We have share premium, and we have returns. Also, ICAN did not tell us it's whether return inward or outward, but return speaks to the fact that the one you have on the debit is more or less like an expense, but it's not an expense in this case. What is it? Because you have made sales of 680 million, of which you provided in your contracting with customer that whether as a result of defect or whatever it is, they have a window to return those items. And what they have returned out of this 680 is 8. Therefore, this will be like a reduction of our sales. Remember, I've said what constitutes our revenue should be the net sales. And it is net of what was returned to you. And what was returned to you is what we call inwards. And what you return as a result of what you purchase. You to purchase from somebody, probably you are returning to them, we'll call it return what? Outward. That also will be used to reduce your purchases. Okay, that speaks to that. Now, which means these 2 go hand in hand with these 2. Let me just use, let me highlight it. And likewise, I said these 2 goes with one another. And which other one? Okay, for now. Now we also have allowance for trade receivables. Okay. Now, allowance for trade receivables means that you are making what some people will classify as provision. And as I've mentioned it earlier, we don't use the word provision because provision is used especially for a liability. That's why, again, you saw accumulated depreciation. We don't call it provision, we call it allowance, okay? Allowance for trade receivable is the same thing as what some of you would call provision for impairment losses, okay? What also some people would call provision for doubtful debts. Is different from bad debt. Bad debts are debt that it is certain. Probably the company you sold to is bankrupt. Probably the customer you sold to is dead, or whatever it is. That one is certain that you can recover it. But allowance means you are only making an adjustment for expected credit losses. And when we get to IFRS 9, we also discuss about this and how this is determined. But this goes hand in hand in, it's also an assets reserve, which means it is an allowance against your trade receivable. Okay? Against your trade receivable. Let me put them in red. Therefore, things that have common color, whether font color or cell color, means they have something to do with one another. Okay, I think that is that at this point. Now, we'll pick our information one by one. Now, let's start with additional information. I always advise students to start with additional information so that you don't lose any line of thought. Okay, because unlike I'm using Excel, I can easily adjust for it. But if you're in the exam, in a paper-based examination, it might be more or less of horrendous cost, humongous cost, and huge cost for you to bear if you miss any information. Therefore, I can create my working note here. Now, the first one we want to talk about inventory. Note 1. Inventory valuation as at 31st December 2020. Now, what do they say about the inventory? Okay. Now, what was said about the inventory is that inventory as at the end of the year was were 120 million naira. Okay, that means inventory costing as at 31st December 2020 all figure in thousands was 120 million. Okay, now we're getting information that included in closing inventory was damaged item with a cost of 30 million. which has a net realizable value of 18 million. What this suggests is that a portion of the inventory, let me separate the portion, damage, sorry, let me charge, my laptop is not in charge, just give me 1 second. Okay, I'm back. Damage goods or damage inventory. We're told is 30 million. Now, because they are damaged, you can't sell it for what it is. What you can only get back from those damaged items is 18 million, which means this cannot be sold for its worth. Therefore, there's a loss that you need to recognize, like a write-off. And if you are familiar, most students will prefer to buy sardine, all those dented meat, dented sardine, and all sorts, because they are sold for cheap, because nobody wants to buy dented. And therefore, that's why you see that they throw those ones out at a very low price in order to salvage value, which means you compare your cost of damaged inventory with the realizable value, net realizable value. Okay, the cost is 30 million. The net realizable value is 18 million. Therefore, what do? You compare. What is the loss in it now? Sorry, my system is rotating. Okay. Now, what is the loss in it? The loss you have is the difference between these two. And that is 12. And this 12 is the write-off from inventory. Damage. Therefore, that means that I can no longer recognize the inventory at 120, but it is at 120 less the write-off. And that is how much is the new value of inventory. Yes, and this is what you'll have done with Gabriel on IAS 2. And we are just demonstrating it now, which means this is a carrying amount of inventory after recognizing the write-off. And that's what we've done in this case. Now we have successfully done this, which means our inventory is no longer 120, but it is 120 less 12, which is now 108. And that is what it is at this moment. Now we have dealt with that first additional information. The second one says additional ordinary shares of 50 million were issued and fully paid at 80 kobo. Now, noting additional paid-in capital, which means in that year, new shares were issued. How many were newly issued? 50 million. Okay, 50 million were issued. Now I'll put this figure in thousands because all figures are in thousands. I have to be careful not to create confusion with those figures in thousands, which means everything now is 50 million. Now, what is the nominal price? The nominal price per share. Remember, when I was explaining the trial balance, the nominal price per share is 50 kobo, which means I'll come here and say 50 what? Kobo. Okay. Now, what is the issue price? Issue or market price? Now, the information here says it was issued for 80 kobo. Therefore, this 80 kobo. Now, it means there's a premium on new issues. What is the premium? The premium is the difference or the excess of the market price over the nominal price, which means the premium is 30 kobo. Therefore, ordinary share capital will increase by what? It will increase by the 50 million shares multiplied by the 50 kobo. Per share, which is the nominal value. And what is that? 50 million multiplied by what? 50 kobo. That gives me 25. Therefore, 25 in naira, I can put it on top here. That's 25 million. Also, share premium will increase by 50 million multiplied by 30 kobo. Remember the premium. So that both 50 kobo and 30 kobo will now make up the issue price. Okay, therefore, $50 million times 30 kobo premium will give me 50 million times 30 kobo will give me 15. This 15 is equivalent to increase in bank balance. Bank balance increases by $80 kobo, because it's 80 kobo you received, which is the issue price. And therefore, we can reflect that in our accounting what? Entry. And why are we doing this? Is because information we have at hand is that this has not been recorded. Where is it? This is yet to be recorded. Let me highlight it in red. I'm bolding it. That's why we are reflecting it again as an adjustment. If it has been recorded, we won't be doing it again. Therefore, what is the accounting entry to pass? Is that there has been increase in capital and there's a reduction in bank balance. Now, remember again for accounting entry, capital and share premium are component of equity. If you are to increase them, you need to credit them more. Cash is a component of assets, which is debit balance. If you are to reduce cash, you have to credit it, which means to take opposing position. Therefore, what is the accounting entry? Accounting entry is as follows. Debit we are the one issuing shares. Therefore, we have to debit our assets for getting more cash into our bank account. Therefore, we debit our bank account to increase it more by how much? By 40 million. We credit our ordinary share capital with how much? With 25. And also we credit to make up for the balance, share premium. How much? 15. Therefore, you find out that the sum of credit is also 40. And that's what we mean by for every debit entry, there must be corresponding credit what? Entry balance. Sorry, did I multiply? And that's what we've done here. Okay. Okay, that is that. Now, the third adjustment is that interest on loan is outstanding. Why is it outstanding? Remember, I explained something here. The interest here was only accrued for 6 months based on these dates and the year end. And we are also aware that the loan has not been paid, which means that we have not yet accrued for our interest for the last 6 months. Probably because it has not been paid, that's why we have not accrued. But accrual principle requires you to more or less recognize your expense when it is incurred and not necessarily when it is paid. And likewise, recognize your income when it is earned and not necessarily when it is received. Therefore, in this case, we come here to note 3, accrual of interest expenses for the remaining 6 months. Now, what is the interest rate? The interest rate is 10%. Is it 10%? Yeah, 10%. How do I know? The loan carry 10% here, also corroborated here at 10%. What is the loan note? The amount of the loan note is 100,000. is 100,000. Therefore, accrued months, 6 months. Total months in a year, in a calendar year, is 12 months. Therefore, I can now come here and say accrued interest for remaining 6 months due is 6/12 multiplied by 10% multiplied by 100 million. And that gives me 5 million. Okay, that is that. Remember, I'll show you something as a proof. If I've not recognized expense at all for the year, which means if this 5,000 has not been recognized at all, it means I have to recognize for full year, which means I have to accrue for 12 months out of 12 months, which will give me 10,000, which is simply as 10% of 100. And if it has been totally accrued for, therefore, I only have a 0 month to accrue for, and there's nothing. And that's what that just means. Okay. Therefore, what I have to do is that we are told that it remains outstanding. Okay, which means what will I do? Accounting entry. Interest is an expense. I'll debit. Finance cost. And I'll credit my liability. I'll call it interest what? Payable. I can put it as other payables. How much is it? 55. Next one is that dividend of on 12% preferential capital were paid on December 31st, 2020. And they said these were yet to be recorded in the trial balance. Let me highlight that again. Which means something has happened which has not been captured in our books. Therefore, part of year-end adjustment or closeout adjustment you do is what we are doing now. Which means we need to determine what amount of preference dividend were paid. Preference dividend paid and omitted in the trial balance. Note what? Note 4. Now, what is the rate of dividend on preference shares? We're told it's 12%. I mean, it's a 12%. Yeah. I come here and say 12%. What is the preference shares capital? The preference share capital Let me link this so that I can know where it's coming from. I'll also link preference share capital to know where it's coming from, 120. Okay, the question then is, what is the dividend paid? Dividend paid is a fixed percentage of the value capital, which is 14.4. Therefore, that is it. Now, since it has been paid, but not recognized in the books, I also do my accounting entry. Now, the question then is, this preference share capital, is it an equity or is a liability? In the trial balance, we may not be able to know except if they've told us that it's 12% irredeemable or 12% redeemable, or 12% cumulative, 12% non-cumulative. But I won't go that route. But when I look at the pattern to which it is drawn, it moves along with loans, which probably it is much more redeemable preference share. But I won't judge by that. I have to come to additional information. And from this additional information, nothing signifies that it is equity or it is liability. But again, I can see that it always moves along with loan. Okay, but that is still not a justification. Now, if you find yourself in this situation that there is no basis of you identifying whether directly or indirectly, you then need to make an assumption. I'm going to make an assumption here that this is liability. And I'm still going to make another solution here, which I will assume that this is equity. And let us see what the implications are if it is liability and if it's equity. But let me tell you something. ICAN committed a mistake in the Pathfinder solution. Why? On one bread, they treated preference share capital as a liability, but they now treated the dividend as the same way they treat dividend on equity, which means they deducted it from retained earnings instead of treating it as a finance cost. Now, let me refresh your mind again to our discussion before now. Whenever preference share capital is treated as a liability, the preference dividend paid on it is treated as a finance cost. Forget the word dividend. It is treated as a finance cost. Whenever you treat preference share capital as equity, the preference dividend there will be treated as a distribution, not an expense, which means it will be treated as a deduction in similar way we deduct dividend due or paid to ordinary shareholder from retained earnings. But in the ICAN solution, on one bread, they treated preference share as a liability in the balance sheet, while in the income statement, they treated the preference dividend, sorry, the statement of changes to equity, instead of income statement, they treated the preference dividend as a distribution to equity holders. I'm going to correct for that here, which means the first assumption you make here, I make my assumption here. And what is the assumption? The assumption here assumption. The preference share capital is treated as a financial liability. Therefore, that's my assumption. I'll put it in green. And we are going to replicate the solution where we change the assumption so that we can see the implication. Okay. Now, in this case, that means that the interest will be treated as finance costs. And what's the finance cost? 14.4. And since it has been paid, what happens to our bank balance? It reduces. Therefore, we credit our bank balance. And that is that for now. Also, let's go back to the question. Likewise, existing ordinary shareholders were paid a 5 kobo per share dividend on the same date. And that also was not recorded, which means we'll come back here. I'll call that note 5. This ordinary shares, sorry, ordinary dividend, not ordinary shares. Okay, now rate of ordinary dividend or rate of dividend paid to ordinary shareholders. Now it's not percentage, it's in kobo. That is 50 kobo. Is it 50? No, 5 kobo. Okay. Let me borrow that Naira sign somewhere. I have it somewhere here. I have it here. Okay. What is the number of shares? Number of ordinary shares outstanding. Okay, now let's go back. How many shares were existing as at the end of the year? And 2, you can see that they said existing ordinary share, which means the new shareholders which just subscribed may not have benefited from the dividend because probably it's at the end of the year, they are just subscribing for the shares. The capital has not worked in that year. That's why probably they mentioned here, let me highlight it, existing ordinary shareholders. Existing ordinary shareholders. Let's take note of that. If that is the case, it means existing. Let me put it here, existing. You have to pay more attention to detail. And also, if you have understanding of the business domain, you don't expect somebody that just contributed capital to be getting dividend on what the capital has not generated. Okay, which means existing shares were how many shares before now? Look at our share capital. They didn't give us number of shares existing, but they gave us that the share capital was 150 million when nominal price is 50 kobo. Who can tell me? And you can put it in the chat box. What is the number of shares that at 50 kobo will have given you 150 million? Who can tell me? I'm waiting for your answers. Okay, Benga said 300 million. Okay, how do you get that 300 million? Therefore, I'll take one step further. The step further means that to determine the number of shares, you need the share capital. You divide the share capital by the nominal what? Price. And that should give you that result. Okay, how do we get that? The share capital is 300 It's 150, sorry. And the nominal price, if you remember, is 50 kobo. And that's how we got these 300 million shares. Okay, I'm coming back to someone that said he or she needed guidance, or not. Come back to that. Okay, I can also write it here. 150 million divided by 50 kobo. 50 kobo is 4.50. Okay, now if that is the case, what is my amount of dividend paid? It is now 5 kobo times 300 million shares. And that will give me, in Naira terms, $50 million. Is it 50 million? Yeah. 50 million. Okay, now I'll also explain. In the ICAN solution, they didn't consider the word existing. They considered total number of shares. Okay, which means instead of arriving at 15 million, what they did is that if you consider all shares, for example, let me change this to all shares means apart from this existing, I'll also have for the new. I'll say this is for existing. I'll replicate it for new. New, we already have new. I don't need to calculate for new. For new, remember, for new, we're given the number of shares here, 50 million. Therefore, I'll add 50 million there. Which means all now, all or total. Will be 350. Now, therefore, 5 kobo times 350 instead of 300 will give you 17,500. And that's what ICAN did. I can consider all, but I consider the phrase here says existing. Now, existing, now again, there might still be an argument to say these new shares were also existing at the end of the year. But peradventure, they were issued towards the end of the year. Therefore, they should not rank pari passu. And I'm speaking from the benefit of hindsight when we get to IAS 33, where we talk about earnings per share. And you get to that level. But another argument again, and that's why you need to make assumption. Another argument again is to say that since there's no information spectacular to tell us when these ordinary shares were issued, who says it was not issued on 1st of January? I'll say, yes, you may be right, but I can still argue it further on the premise that how dare can you, which kind of error will you have made that you issue shares as at the beginning of the year or earlier in the year, and you are yet as at the end of the year to have recorded it in your trial balance? Which means that is that is a grave error. Do you get what I'm saying? Now, which means you can always argue. But in this case, if you go by the principle of understanding how things goes on in practice, this will have been much more of the fact that these shares were issued at the end of the year, of which collation ended after the year, and probably that's why it has not been updated in the trial balance. And on that premise, also, they said existing, though the existing was on December 31st, but probably existing ordinary shares before the new issue as at that date. But the question is this: what we are teaching you is to have understanding and open mind about situations, scenarios. And that's why I always tell you that I give solutions, I don't give answer. Because if I give answer and the dynamics of transaction changes, you might not be able to think out of the box to treating such transactions. Which means depending on what you consider, but again, probably I can just more or less consider the words existing from the angle of what is outstanding as at the end of the year. Or probably you can consider existing from the angle of old shareholders. Let me put it there, old shareholders and the like. But again, you must state your position clearly, and that is clear in that manner. Okay, but I think I'll retain what I have because I have more superior argument to show that existing may not have included that. But again, when you have the access to the video and the other one, you can always play with this, and that's why it's a model. Okay, now since it has been paid, I'll also treat it. What is the accounting entry? Now, this is not an expense. Dividend paid to ordinary shareholder is a distribution. Therefore, it will be charged to retain what? Earnings. Charge to what? Retain earnings within the statement of changes in what? Equity. Since we have paid it to bank, we also take note of that. And that is it. Okay. Somebody is trying to write on my screen. Let me disable annotation. Okay. That is that. Now, what other notes? Okay, note 4. Sorry, additional information 4. What is that note now? We'll call it note 5. And what is it? Allowance for trade receivable are to be increased to 15%. Increased to 15% per annum. Okay. Now, the question is this. Note 6. Allowance for credit losses on trade receivables. Now, what is the loss rate? The loss rate is what is given to us at an average of 15%. Therefore, my loss rate is 15%. And what is the exposure at default, which is my trade receivable balance as at the end of the year? My trade receivable balance as at the end of the year, if you go back to our trial balance, is 360 on the debit. Okay, which that means that my allowance for credit losses on trade receivable, which is simply as impairment losses. Credit loss is simply as impairment losses, which we are going to come back to, is what? 15% multiplied by 360, and that's 54 million. Now, this 54 million, what do you do with it in that regard? Okay, this 54 million, we had allowance before now of 10 million. Therefore, we'll now determine increase or decrease in allowance for impairment losses. Now, remember that last year we made allowance of 10 million. That's why we brought it forward, this balance sheet item. This year now we are making allowance for 54 million. Therefore, is there an increase or decrease in allowance, or what you call provision for bad debt? Therefore, I'll compare my opening allowance for credit losses on trade receivable. I'll compare it with the closing allowance. And you tell me what the movement is. Is there an increase or a decrease? Opening was 10 million from the trial balance, and closing was 54 million from our computation. Therefore, the difference or movement, what can we call it? Is there an increase or a decrease? You can write it. Okay, I can see you writing. Increase, yeah. There is an increase. Increase in amount of impairment losses. And therefore, if it's an increase in a loss, is there an expense or an income? It is an expense. Therefore, and that is that. Okay. I recognize that in my book. And how do I recognize that? Accounting what? Entry. Now, it's going to charge that increase to profit or loss, and it's going to be charged to profit or loss under distribution expenses. But again, some people charge it under admin, but what matters is consistency. Some people think it's distribution, or because if you have not made sales by distributing to customer, you won't have had that loss of collection. But again, whether it's distribution or admin, your policy matters, your consistency matters. For this case, we are going to take it to distribution costs, and you charge it as an increase to your allowance. Remember, our allowance was 10 before. It will now move from 10 to 54 by adding 44 to it. Therefore, what's the name we gave it here? Let me just copy the name. Allowance for trade receivable. And how much is that? 44 million. And that is it. Yeah. And we are the last session now. Okay, before last session, depreciation is charged on plant and machinery at a rate of 15% of reducing balance. I believe we know the difference between reducing balance and the straight line method, but we'll see it here again. Note 7. Depreciation charge on PPE on reducing balance method. Okay. That's note 7. Now, first, what is the cost of the PPE? Cost of the assets. The cost of the assets is 950. Now, because it's reducing balance, we need to deduct the accumulated depreciation as at 1st of January 2020. Remember, this cost is also as at 1st of January 2020. Okay, therefore, I deduct this. Remember, I explained this earlier on, which means as of last year, the carrying amount of the assets was 560. Okay, if that is the case, the reducing balance method, this is the carrying amount, or what some people call net book value. As at 1st of January 2020, which was December 2019. Now, if that is the case, therefore, what do we do? What we do then is that our depreciation rate is set to be 15%. Therefore, since it's reducing balance method, therefore our depreciation charge for the year will now be 15 multiplied by 560. You have 84. And this is our results. Okay. Let me now ask a question. What if it is on straight line method? If it's on the straight line method, the result will have changed. The result will have changed to 15 of the cost, not of the net book value, which will have been 142, which means we are spreading it equally over some period of time. Okay, but that is not what we're told in the question. Therefore, I'll strike it out. But I'll leave it there and strike it out for your understanding. Okay. Now, what is the accounting entry? The accounting entry is you debit your admin because it says something about where we should charge depreciation to. Depreciation is charged on plant and, okay, sorry. Here's it. Depreciation is charged to administrative expenses. Therefore, I'll come here and say, sometimes it might be charged to cost of sales if it relates to factory equipment. Sometimes it might be charged to distribution costs if it relates to motor vehicle for distributing products. But in this case, we're given express instruction that we should charge it administrative, and therefore we credit, which means our allowance, our accumulated depreciation is no longer 390, it's not 390 plus that 84, which means what do? We credit this to increase it so that by the time we charge it against the assets, the kind amount will reduce further. Okay, and how much is it? 84. That is that. Okay, what other information? 5 million administrative expenses were outstanding. That means there is 5 million administrative expenses that were also approved, which means I'll come to note 8. Accrued portion of administrative expenses. I cannot consider it as other expenses. Therefore, what do? I account for them 5 million. And because it's accrued, it goes to accrued expenses account as a liability, which I'll group as other payables. Remember, we have one other payable before, which is the interest payable. If you remember interest payable here, we have another payable again. Therefore, we take note of all of this. Okay, what's the final adjustment? 25 million company income tax is estimated for the year. Okay, we are still coming back to IAS 12. We'll be discussing income taxes, but in the interim, yeah, they've already determined the income tax, only that we need to accrue for it. Yes, accrued income tax expense for the year. Now, there is no opening balance to show whether we are owing last year. Probably there was no tax last year, or we've paid the tax immediately, whether through withholding tax credit or whatever it is. But in this case, we are told that there is no opening balance. The first one we have now is to accrue for income tax. Income tax is a separate line within the statement of profit or loss, and therefore we have income tax expense, which is a charge. And because it is here to be paid, we recognize it as current tax paid to the Federal Inland Revenue Service, and that is 25 million. And that represents all of the adjustments. Now, let me come back to note 3. Note 3 deals with accrued interest expense. Now, if you go back to the information, it says interest on loan note is outstanding. The examiner even pointed to a direction that something is outstanding. The question then is, what is outstanding? I will have assumed that the whole year is outstanding, which is 10% of 100,000 times 12 months over 12 months, which means 10 million is outstanding as interest. But if I move further up, I was told here, let me highlight this and this, they have something in common. I was told here I was told here that interest for 6 months, see, as at 30th June, from beginning of the year to 30th June is 6 months, has already been accrued for and even paid because it was paid. Therefore, in this case, I've already taken care of 6 months, which means it's only 6 months that is outstanding, not 10 months, and not 12 months, because I can trace the first 6 months here. Now, the next 6 months is what I've accrued for here independently, which also got the same thing, which means first 6 months have been accrued and paid for. Second 6 months has not been accrued for at all. And how do I accrue for it? 10% of 100,000 is going to give you a full year interest. And I have to prorate it with number of months that is outstanding out of the total months that make a year. And that's how we arrive at this, which you can more or less follow through. And as it is, it's a finance cost, which is charged to profit or loss as an expense. And because it's here to be paid, it becomes a liability. If it has been paid like dividend, we'll have reduced our bank account, like this preference dividend that you saw here. Okay. Now, let's now pick it one by one. What is our revenue? My revenue now probably will be note 9 and note 10. What is it? Let me go back to note 10. Let me create note 10. I'll create it from here. Note 10. Note 10. Revenue, which simply as net sales. And what is it? It is my revenue or my sales less return inwards. What is my sales? My sales is 680, and my return inwards, if you remember, somewhere here, is what? 8. Therefore, what is my revenue? My revenue, in this case, is what? Is the net. $672. Therefore, I can link it and say my revenue is 672, which is my net sales. Let me write it there, net sales. Now, what is my cost of sales? Note 11. Note 11. My cost of sales, or same as cost of goods sold, is my opening inventory plus what? Plus my purchases in which out of my purchases I deduct my return what? Outward, that is return to my suppliers. Okay, what I get there is my cost of goods available for sale, what some people call COGAS. And I'll compare that with my closing what? Stock. Closing inventory. Now let me do that. Now my opening inventory was how much? 80. My purchases was how much? 300. You said I should reduce from it, return outward. Remember, that's 6,000. What do you have there? My COGAS is 374. And less my closing inventory. Remember my closing inventory, you can see that from notes. What notes? I think that was the first note. That's it, note 108. Refer to note 1. Can you see it? Therefore, what is my cost of goods sold? Sorry. 266. Okay. I link it. Note 11. Now, what is my gross profit? Is a difference, which is 406. Now, what's my distribution expenses, admin expenses, and co? Therefore, let me create a schedule somewhere here. Let me call that notes 13. Analysis of administrative expenses, distribution cost, and other income. All figures in thousands. Okay. Now I'll start with trial balance. I have discount allowed and discount received. Okay. The discount allowed is an expense under admin. No, sorry, under distribution. That is distribution costs. Admin expenses and other what? Other income. Now, discount allowed is an expense, which is 10. It goes under distribution. Discount received is an income. It goes under income. Distribution expenses goes under distribution. Administrative expenses goes under admin. Bad debt written off goes under distribution. But again, I've told you, some might also treat under admin, but you have to be consistent with what you do. But mostly in exam, you treat it as distribution, or depending on what the examiner gives you as a guide. Okay. Now, return inwards, return outward, we'll dealt with that in purchase and sales. Now, impairment losses. Remember, we had increase in impairment losses. What note is that? That's note 6. I'm going to reference that note. That increment goes to distribution cost according to our entry here. Okay, sorry. It's the name I want to pick here. Okay, somebody on iPhone is raising up hand. I'm coming to meet you now. Take note of that. Okay. Let me just copy and paste. Reduce the length. Okay. I'll put that as note 6. 6. Note 6. Okay. Okay, we'll now pick other expenses. On that note, we are coming back to interest later. Depreciation, yeah. They said we should treat it as admin. We'll pick depreciation. And we are also coming to pick other accrued expenses, depreciation. Depreciation. That's not 7. We'll put that under admin. That's 84. And we also have other expenses. That's not 8. That's it. I guess that's all for now. Therefore, I can sum it up like this and link it to where I want it to be. Therefore, I can come to my income statement now. Distribution costs. Admin costs. And income will be this. Now, there are 2 ways I can do it. I can do it in this way and sum it up here, which means when I do that, times I have 302. Or I can more or less move my income separately here And my expenses, I can aggregate them here and bring my operating expense here. Okay, therefore, let me do something. And I can put this here. Operating expenses. Okay. Now means my operating expense is 310,406 and 8. Therefore, what can I do? I sum everything together. I have 104. Therefore, finance costs. Remember, this is note 12, are we? Yeah. Not 12. Not 12. I use one note to do, is it not 12? That's not 13. Which one is not 12? Okay, I label it wrongly. This is not 12, not 13. Not 12. Yeah. Okay, finance costs. I go back to determine my finance costs. My finance cost should now be not 13. Not 13. Finance costs. Now, there are two things we need to consider. First, from our trial balance, we have interest for this period, which is 5,000. Now, also in note 3, we had additional 6 months. And which was how much again? There's additional 6 months. Okay. When you add the 2 6 months, it gives us 10. It gives us 10. But don't forget, we also have preference dividend, which is not, which I spoke to the other time. Since preference share capital is treated as financial liability, therefore, the dividend is treated as finance cost 14. At the end of the day, at the end of the day, our finance cost will be 24,400. Okay. Take note, this arose from adjustments. And the reference to the adjustment is given, as you can see here, note 3, note 4. Therefore, I can come to my income statement and say my finance cost is note 13. And you guys can see it from there. Okay. Now, what is my profit before taxes? Now, my income tax, if you go back, that was note 9. Note 9. And there's no other comprehensive income. I just put it there, 0, which means my total comprehensive is this. Now, this is my statement of profit or loss and other comprehensive income for the year. Now, let me remember this note 9, and that is it. Now, let me quickly attend to this person's question. You can unmute yourself. I've given you access. The person raising up hand, I've given you access. Can you unmute yourself? Okay, since the person is not talking. Okay, there's somebody here, Bright. Okay, not Bright. Bright, you said 15% of 580 won't give 840. Where's the 580? Where's 580? Okay, that's the depreciation. When we are computing depreciation, it's not 580, it's 560. It's 560. Who said 580? Okay, that has been corrected. Okay, thank you, guys. Okay, thank you. Okay, now let's move to the balance sheet. Okay, before the balance sheet, statement of profit or statement of changes in equity. Now, my statement of changes in equity. Now, what were the balances we have as opening? We have opening capital, share capital, 150. We have opening share premium, 90. We have opening retained earnings, 252. No other component of equity. I just put it there to address other comprehensive income. When we sum it together, our opening equity is 492. Now, what has happened during the year? We made profit during the year. Profit we made during the year, if you remember, you go to your profit or loss, profit for the year, you put it there. If you have other comprehensive income, which you don't have, I just link it there. This is 0. You have it there. Now, transaction with equity, there was additional paid-in capital. If you remember, notes, what note was that? Note 2, as you can see it here. Therefore, our share capital increased by 25, which is this, and share premium increased by 15, which is this. Therefore, we'll come here, note 2, we'll make reference to note 2. Note 2, share capital increased by 25. And share premium increased by 15. Okay, dividend. Remember, it's only ordinary dividend that we are considering here because preference has been treated as finance cost. But we are going to do the second module where we treat preference dividend also as distribution. And where is it? Yeah, 15. And again, remember what we discussed about that 15 is that it could as well be 17.5, depending on how we treat existing number of shares. Okay. Therefore, that is not preferential capital, preference dividend is not 5. Not 5. Not 5. Okay. Therefore, we can sum it across board. Okay, and I can also sum it vertically. And I give him 571,600. Okay. Now, my balance sheet. My PPE. Therefore, I think I stop at note 13. I can have note 14 now. Note 14. Property, plant, and equipment. Okay. I start with my opening, which is my cost. There was no addition for the year. Therefore, I just take my 950. Accumulated depreciation. As at 31st December 2020. How do I arrive at it? I arrive at it based on accumulated depreciation as at beginning of the year. Plus depreciation charge for the year. What's depreciation charge for the year? That was note, what note was it? Okay, note 7. That was 84. Note 7. Note 7. $84. Note 7, 84. Okay, our opening is from our per balance, which we have here 390. Therefore, when you add the two together, when you add the two together, what do you have? You have the accumulated at the end of the year that you want to deduct, which is 474. Therefore, what is my kind amount at the end of the year for PPE? Assets. Sorry, that's not where I'm supposed to put it. Therefore, what is that? I combine the two and it gives me 476. I come here, I say note 14, I guess. Note 14. 476. No other item. Therefore, my inventory, I think I have that in note 1. Note 1. What is my note 1? $108. Okay. Paid receivable. You can do note 15. Which means my trade receivable is my trade receivable opening balance, less my allowance for impairment losses at the end. Okay, what is my trade receivable? Remember, it's 360. My allowance is no longer 10. It is now 54, if you remember. Where do you have that 54? It is 54, because you have increased it by 44. Okay. I put this as a deduction, negative. And that gives me 306. Therefore, note 15 is 306. Fine. Will be note 16. Remember, there are monies we received from shares that has not been recorded and payment we made that has not been recorded in terms of dividend. Therefore, note 16, bank balances. As per accounts, we have 160. But if you remember, there were 3 items that were not considered. 1, additional paid-in capital in note 2. There was an additional paid-in capital of how much? If you remember, we said we should credit bank with 40,000 or 40 million. 2, in note 6 or 7, okay, note 4, we paid preference share, 14.4, which we said we should deduct from our bank. Can you see it here? Also, in note 5, we paid ordinary dividend of 15. Ordinary dividend of 15. Okay. That is that for the bank. Therefore, what is our balance in bank? 170,600. What is equal? Not 16. 170,600. Therefore, what's our sum? That should give me this. Therefore, I have to sum non-current assets with current assets. And what does that give me? Give me total assets of this amount. Now, share capital. We already have that in our statement of changes in equity. Therefore, I just transpose it. If I have it here, I have them here. Sorry, let me take it up. Let me do it one by one. I don't know why it's failing. Therefore, that's my statement of changes in what? Equity will give me my total equity. Now my loan notes still remain 100. Interest is separated from it. And my preferential capital is 120. Therefore, what's my non-current liabilities? That is it. Now my trade payable. My trade payable for my trial balance is 234. My current tax payable, if you remember, note 9. Note 9, because it's yet to be paid, it's only estimated. I'll put that note 9. Interest payable and other payable, I think I've collapsed that. Therefore, I'll just take it as other payables. Okay, other payables. I can do that as note 17. Note 17. Now, the first other payable there was interest expense. If you remember, the other payable was admin expense. That's note 8 and note what? Note 8 and note 3. Okay. Note 3 and note 8. Okay. Therefore, what do I have? Note 3. Note 3 is 5. Note 8 is also 5. That gives me 10. Okay, I can link that now. That's not 17. Therefore, what is my total current liability? And my total liability is non-current liability plus current liability. And my total equity and liability is total equity plus total liabilities. And we can find that the balance sheet agrees. Okay. Now, this is the first solution on the premise that we treated dividend. I'll call it version 1. We treated preference shares as what's it called? As financial liability. Now, what will I do? I can just copy and duplicate, and I'll call that version 2. What am I just going to change there? Is that here where I assume that preference share capital is financial liability, I will now change it that preference share capital is equity. Equity instruments. Let me put it in blue. Okay. Now, what would that be? Instead of treating it as finance cost, I'll treat it the same way I treated this, as a return, which means is a deduction. And what that means that in that case, I'm not going to more or less treat it as finance cost. Where did we have our finance cost earlier? Finance cost, this will not be there. This will not be there. Therefore, preference dividend will not be there. Let me strike it out. This will not be there, which means this is just these two, which we adjust for. Rather, when we come to statement of changes in equity, we now split this dividend into 2. We split this dividend into 2. We have one as ordinary dividend, and we have the second as preference dividend. That means this dividend will be 2. Preference share. Second one will be ordinary share what? Holders. And in that light, this is not 4, I guess. Therefore, not 4, I deduct that. Not 4, this is. Now, if I do that, you see what has happened? And that will flow into my account. Now, my stuff is no longer liability. Therefore, I can now have here preference share capital. This preference share, I'll bring it up here. And therefore, this, I'll bring it up here. Okay. And this, I'll just take this down. Okay. Therefore, my total is here. And we see I have at the same thing. The only difference is that, one, the profit will be different. If you check the profit before is 54,600. Now the profit now is 69 because the finance cost has been reduced and it is taken as a distribution within the statement of changes in equity, as you can find it here. As you can see it here. Therefore, I can equally extend this and have my preferential capital there. 12% preferential capital. Opening balance is this 12. There's no addition at all in that year. And therefore, everything comes back to this, which is the same thing we have here. I'll just link it here, and I can link it there. Therefore, that is it. That is it. And that's how we have it there. And that's just the difference in case of future. Okay, how do you treat preference share as equity? One, you more or less recognize it within equity. Two, the finance cost, the dividend is treated as dividend return, which is deducted from retained earnings. And if it is otherwise as a financial liability, rather you deduct the finance cost, you deduct the dividend as finance cost, while you recognize the preference shares as a liability. And that is that. Okay, if there's any other question, can you raise up your hand or send a chat? I believe we'll make justice to this. And I'm going to give you this model solution workbook for your own personal revision and study. And one beautiful thing is that you can play with the model so that it changes your position as the case may be. Any other question as you guys prepare for physical class? Any question? Okay, in the absence of none, thank you very much and God bless you guys. Bye.